Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. Our focus this week is on the latest decision of the Central Bank of Nigeria's Monetary Policy Committee. CBN holds interest rates at 26.5%, why the pause matters for the economy and investors. The Monetary Policy Committee held its 305th meeting on 19 and 20 May 2026 and decided to retain the monetary policy rate at 26.5%. The committee also retained the standing facilities corridor around the MPR at plus 50 and minus 450 basis points and kept the cash reserve requirement at 45% for deposit money banks, 16% for merchant banks, and 75% for non-TSA public sector deposits. This decision means the CBN is not yet ready to cut rates, but it is also not tightening further. In simple terms, the CBN is taking a cautious pause. Inflation has risen slightly, but the committee appears confident that the current macroeconomic environment can still support a return to disinflation. Why did the CBN hold rates? The major concern was the slight rise in inflation for 2 consecutive months. Headline inflation increased to 15.7 points in April 2026 from 15.4 points in March 2026, largely driven by food inflation, which rose to 16.1%. This was linked to higher transportation and logistics costs as well as seasonal factors. However, core inflation moderated to 15.9%, while month-on-month headline inflation eased to 2.1% from 4.2% in March, suggesting the pace of price increases slowed. The MPC also noted the impact of the Middle East crisis on global economy prices and logistics costs.
The MPC particularly noted the spillovers from the Middle East crisis, which have exerted upward pressure on energy prices, costs of transportation, and other logistics.
However, Nigeria appears more resilient than before, supported by exchange rate stability, stronger external reserves, improved monetary policy transmission, a well-capitalized banking system, and ongoing fiscal consolidation. These reforms have helped reduce the pass-through of global shocks into domestic prices. What this means for savers? For savers, the decision means there is no immediate reduction in benchmark interest rates. Savings and deposit rates linked to the MPR should remain broadly stable for now. However, inflation remains higher than the returns on regular savings accounts, so keeping too much money in ordinary savings accounts may erode purchasing power over time. Savers should keep emergency funds liquid but consider credible money market funds, treasury bills, fixed deposits, and other regulated fixed income options for excess cash. What this means for borrowers and businesses. For borrowers, there is no major relief yet. Lending rates are likely to remain high because MPR remains elevated at 26.5%, while the CRR remains tight at 45% for commercial banks. This leaves banks with a significant share of deposits locked with the CBN, limiting liquidity available for lending. Businesses should therefore manage debt carefully. Expansion plans may need to be phased, and companies should explore supplier credit, equity-type funding, or internally generated cash flow where possible. The good news is that if inflation resumes a clear downward trend and FX stability continues, the CBN may have room to cut rates later. What this means for fixed income investors. For fixed income investors, the rate hold keeps yield relatively attractive in the near term. Unlike a rate cut which could have strengthened expectations of lower treasury bills and bond yields, this pause keeps the high yield environment alive for now. However, investors should watch inflation closely. If inflation begins to decline again, yields may start to move lower ahead of future rate cuts. Therefore, current fixed income yields may still be attractive to investors seeking to lock in returns, especially when the tenor matches their liquidity needs. What this means for the stock market. For equities, the outlook is mixed but still supportive in the medium term. High interest rates increase borrowing costs and keep fixed income instruments attractive. However, the CBN not raising rates further reduces the risk of additional pressure on businesses. The external reserves position remains relatively strong, though it has eased slightly from the end March level. Nigeria's external reserves stood at about $49.2 billion at the end of March 2026 before easing into about $48.9 billion as of May 21, 2026. Despite the slight decline, the reserves level remain healthy and continues to provide an important buffer for exchange rate stability, investor confidence, and the economy's ability to absorb external shocks. Key investor takeaway. The May 2026 MPC decision is best described as a cautious pause. The CBN is not cutting yet because inflation has risen slightly, but it is also not tightening further because the broader macroeconomic environment is improving. For investors, the strategy should be balanced. Fixed income investors can still take advantage of attractive yields. Equity investors should focus on fundamentally strong companies with pricing power, robust earnings, dividend capacity, and healthy cash flows. Businesses should be cautious with debt, while savers should avoid leaving too much idle cash in low-yield accounts. Overall, the key message is clear. Nigeria's macroeconomic story is improving, yet the CBN is opting for patience over excitement. The next MPC meeting is scheduled for 20 and 21st July 2026. The key indicators to watch before then include inflation, oil prices, exchange rate stability, external reserves, and food supply conditions. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed and have a great week. Bye.